Your accountant is legally allowed to hide the best tax strategy from you. And the crazy part? Most of them don't even know they're doing it. Let me show you what I mean. In 2024, I paid $127,000 in taxes on $890,000 of income. That's a 14.3% effective tax rate. My neighbor, a cardiac surgeon, made $740,000 that same year and paid $276,000 in taxes. That's a 37.3% rate. He paid more in taxes than I made in my first 3 years of business combined, despite earning less than me. He works 80-hour weeks saving lives. I work maybe 25 hours a week managing investments. Something is fundamentally broken here, right? Wrong. The system is working exactly as designed. You just don't know the design. Today, I'm going to reveal the single most powerful wealth building strategy that the top 1% use religiously, but that 99% of Americans have never even heard of. And I'm going to show you how to implement it starting next month, regardless of your income level. This isn't about tax evasion. This isn't about shady offshore accounts. This is about understanding the actual tax code that Congress wrote specifically to incentivize certain behaviors. And then doing those behaviors. Let me tell you about Marcus. Marcus was a software engineer at Google, making $340,000 a year. Solid income, top 5% of American earners. He maxed out his 401k, had a nice emergency fund, owned his home in San Jose. By conventional standards, Marcus was crushing it. But every April, Marcus would sit with his CPA, sign his tax return, and feel physically ill. $89,000 in federal taxes. $28,000 to California. Another $24,000 in Social Security and Medicare. Before he paid for his mortgage, his kids' daycare, or his student loans, the government took $141,000 of his money. 41.5% of his gross income, gone. And his CPA would say the same thing every year. You're a W-2 employee, Marcus. There's not much we can do. You make too much for most deductions, but not enough to make fancy strategies worthwhile. Marcus accepted this for 7 years. Until he didn't. At a birthday party in 2023, Marcus met an unassuming guy named James. James owned a small chain of laundromats. 3 locations, nothing fancy. When the conversation turned to work, James mentioned he'd just bought his 4th location. Marcus, making small talk, asked, "Man, the taxes on that business income must be brutal, right?" James smiled. "I paid $11,000 in taxes last year." Marcus almost spit out his drink. "Wait, total? What did you make?" "The laundromats cleared about $290,000 after expenses. I took home about $110,000 in salary from the management company. The rest I reinvested." The math didn't add up. $290,000 in income, $11,000 in taxes? That's less than 4%. Marcus made more, paid 13 times more in taxes. "How is that legal?" Marcus asked. James pulled out his phone. "Let me show you something called cost segregation and bonus depreciation." Here's what Marcus learned that night, and what changed his entire financial trajectory. The US tax code has 2 completely different rulebooks. There's the rulebook for people who earn money by trading their time for a paycheck. We call these people employees. Then there's the rulebook for people who earn money by providing value through assets, businesses, or investments. We call these people owners. Employees get punished. Owners get rewarded. This isn't my opinion. This is explicit congressional intent, written directly into the tax code. Here's why. The government wants specific behaviors. They want job creation. They want housing development. They want energy production. They want business investment. So they created massive tax incentives for people who do those things. When you buy a rental property, you're providing housing. The government rewards you with depreciation deductions. When you start a business that employs people, you're creating jobs. The government rewards you with operational deductions and qualified business income deductions. When you invest in oil and gas partnerships, you're supporting energy production. The government rewards you with intangible drilling cost deductions. The tax code is essentially a series of instruction manuals. Do this thing we want you to do, and we'll let you keep more of your money. But here's the key thing Marcus realized. You don't need to be a billionaire to access these strategies. You just need to structure your life differently. Within 6 months of that conversation, Marcus made 3 specific moves. First, he started a legitimate consulting LLC on the side. He spent 10 hours a week helping smaller tech companies optimize their software architecture. Nothing crazy, just leveraging expertise he already had. Year 1, this side business generated $67,000 in revenue. After business expenses, his actual taxable income from the business was $31,000. But here's where it gets interesting. Second, through his LLC, Marcus bought a $45,000 SUV that he used for client meetings and site visits. Under Section 179 and bonus depreciation, he deducted the entire purchase price in year 1. Third, Marcus used $85,000 from his savings to buy a small duplex in a B-class neighborhood. He rented out both units. The property generated $2,400 a month in rent, and cost him $2,100 a month in mortgage, insurance, and maintenance. Barely break even on cash flow. But on paper, that property showed a $23,000 loss in year 1 due to depreciation. Now let's do the tax math. Marcus still had his $340,000 Google salary. But now he also had $31,000 in business income, offset by $45,000 in vehicle depreciation. That's a $14,000 paper loss from the business. He had $28,800 in rental income, offset by $23,000 in depreciation. That's $5,800 in actual taxable rental income. But because Marcus qualified as a real estate professional for tax purposes by spending 750+ hours on his properties and his real estate activities exceeded his time in any other business, that $23,000 depreciation loss could offset his W-2 income. His new taxable income, $340,000 plus $5,800 minus $23,000 minus $14,000 equals $308,800. His tax bill dropped by $18,000 in year 1 alone. But here's the compound effect. Year 2, Marcus bought a second duplex. Year 3, he bought a small fourplex. By year 5, Marcus had 7 rental units and his consulting business was generating $180,000 annually. His W-2 income was still $340,000. But his effective tax rate had dropped to 19%. He was saving $76,000 per year in taxes compared to his old structure. That's $76,000 of his own money that used to go to the government, now staying in his pocket to reinvest. Over 10 years, at a conservative 8% return, that's an additional $1.1 million in wealth. Same person, same income, different structure. Here's what you need to understand. The wealthy don't make more money and then figure out tax strategies. They design tax-efficient structures first, then fill those structures with income. This is the fundamental difference between how the middle class and the wealthy approach money. The middle class thinks, earn, spend, save what's left, pay taxes on everything. The wealthy think, design a tax-efficient structure, earn within that structure, reinvest tax-advantaged profits, compound tax-free or tax-deferred. Let me give you the 3 most accessible strategies you can implement right now, regardless of your current income. Strategy 1. The side business structure. You don't need to quit your job. You need to start a legitimate side business that serves a real market need. This could be consulting, freelancing, e-commerce, digital products, anything. The key is legitimate. The IRS has clear profit motive tests. But if you're providing real value and earning real income, you now have access to dozens of deductions that W-2 employees cannot touch. Home office, equipment, software, education, travel to conferences, a portion of your internet and phone, vehicle expenses. These were always business expenses for entrepreneurs. But as a W-2 employee, you couldn't deduct any of them after the 2017 tax law changes. Strategy 2. The real estate depreciation advantage. Rental real estate is the single most tax-advantaged asset class in America. Period. When you buy a $300,000 rental property with 20% down, you control a $300,000 asset with $60,000. The IRS lets you depreciate that $300,000 over 27.5 years for residential property. That's roughly $10,900 per year in paper losses you can use to offset your rental income, and potentially your other income if you qualify. Meanwhile, your tenant is paying down your mortgage, The property is hopefully appreciating and you're building equity. You're getting paid 4 ways: cash flow, appreciation, loan paydown, and tax benefits. And the tax benefits alone can turn a break-even property into a 15% cash-on-cash return when you factor in tax savings. Strategy 3. The retirement account stack. Most people know about 401 kiloseconds. Maximum contribution for 2026 is $23,500, plus $7,500 catch-up if you're over 50. But if you have self-employment income, you can also open a solo 401k and contribute up to $70,000 per year as both employee and employer. You can stack a backdoor Roth IRA on top of that for another $7,000. If you're really sophisticated, you can set up a defined benefit plan and contribute $200,000 plus per year in some cases. The point is this: the more you can shift income into tax-deferred or tax-free accounts, the more you can compress your current tax bill and allow money to compound without the IRS taking a cut every year. A dollar that compounds for 30 years at 10% becomes $17.45. That same dollar, taxed at 30% first, becomes only $12.21. The tax structure you choose determines whether you're compounding with 100 cents on the dollar or 70 cents on the dollar. Over a lifetime, that difference is measured in millions. Now, I know what some of you are thinking. This sounds complicated. I'll just make more money and not worry about taxes. That's exactly what high-income professionals think, and it's exactly why doctors, lawyers, and engineers often retire with less wealth than business owners who earned half as much. Because it's not about how much you make. It's about how much you keep, and how efficiently you can redeploy what you keep. Let me be crystal clear about something. I'm not suggesting you break any laws. I'm not advocating for tax evasion. I'm telling you to read the instruction manual that Congress published and do exactly what it tells you to do. The tax code is 7,000 pages long because it's not just about collecting revenue. It's about incentivizing behavior. If you align your financial life with the behaviors the tax code rewards, you will legally pay less in taxes. If you don't, you'll pay the maximum rate and wonder why you're working so hard with so little to show for it. Here's your action plan. In the next 30 days, do 3 things. 1. Schedule a meeting with a tax strategist, not just a tax preparer. Ask them specifically about entity structuring, real estate opportunities, and retirement account optimization for your situation. If they say, "There's nothing we can do," find a new strategist. 2. Read Tax-Free Wealth by Tom Wheelwright. It's 250 pages that will completely change how you see money. This one book will make you more money than most college degrees. 3. Identify one income-generating activity you could start in the next 90 days that would qualify as a legitimate business. It doesn't need to replace your job. It needs to generate $500 to $1,000 a month and give you access to business deductions. The goal isn't to become a full-time entrepreneur overnight. The goal is to start building a tax-efficient wealth structure that you can scale over time. Remember Marcus? 5 years after that birthday party conversation, he left Google. Not because he was fired, but because his rental portfolio and consulting business were generating more after-tax income than his salary. He now controls $3.2 million in real estate with about $740,000 of his own money invested. His effective tax rate last year was 11%. His surgeon neighbor? Still paying 37%, still working 80-hour weeks, still wondering why he's not building wealth faster. Same country, same tax code. Completely different results. The only difference is knowledge and implementation. The billionaires aren't smarter than you. They just play by a different set of rules. Rules that are publicly available to anyone willing to learn them. Your accountant isn't hiding these strategies because they're evil. They're hiding them because they don't know them, or because explaining them takes time they're not billing for, or because they're trained to be conservative and keep you safe rather than aggressive and help you build wealth. But now you know. The question is, what are you going to do about it? Are you going to keep playing the employee game, trading time for money and watching 40% disappear to taxes? Or are you going to spend the next 6 months building a structure that lets you keep more of what you earn and compound it faster? The choice is yours, but the opportunity cost of waiting is measured in hundreds of thousands of dollars over your lifetime. Stop paying the maximum tax rate. Start playing the game the way it was designed to be played. I'll see you in the next one.